Hello everyone, and welcome to the PivotBoss Premium Trading Room. Today is Tuesday, May 1st, 2018, and this is our monthly market outlook for May 2018. Right now we have Apple just released earnings. Had it up here as we were getting settled into the room, and you can see the thing popped up pretty sharply right away, rallied to as high as 178 evens right now. That is the high price, still trending up outside of R3. Big time pop higher. This is the 133 tick chart right here. Big time squeeze and move out of this one. 165 has been the major pivot in this chart. Let's take a look here at the higher time frame real quickly. Obviously the market really wasn't going much of anywhere ahead of Apple's earnings. And then late in the day here we started to get a pretty solid squeeze in tech and even the S&P 500. You can see right here the 165 has been a big time key level here for this one. Lower low failure, popped back above that zone. Again, it closed the day 169s. Right now trading 177, so it's up here with 178 being the high. So it's basically filled these two gaps and is now near the upper boundary of this range right now, trading after hours. So that's an incredible move right now. On earnings, it was a beat, I believe, by some measure, but don't remember exactly what right now, but a pretty big move. So okay, let's go ahead and get started here. What I wanted to do today, basically we're going to look at the broader market as we usually do, get some longer term outlook for the month of May in terms of the futures. So we're going to look at the ES, the NQ, crude oil, gold, anything else you all want to look at, and then we're going to look at some stock ideas as well. So we'll be doing some live stock picking. I really haven't done a whole lot of prospecting, but there are certainly some great candidates already that I've seen, and we'll also kind of look at some of the candidates from last month, some of which turned into some stellar movers. So we'll take a look at that as well. So let's go ahead and get started here. I want to look at the NQ for a moment. Here's the NQ from a higher time frame perspective, and again, it's the first trading day of the new month, the first day of May. And for those of you who have my book, Secrets of a Pivot Boss, it was a book that I wrote back in 2009, finished it in 2010, published it in 2010, and it has been a book that continues to have staying power. Even in the face of a changing market, the concepts still hold very true to today's market and all markets, because it's based off auction market theory. It's based on how a market operates. One of the concepts we talk about is the pivot range, and basically this pivot range right here for the month of May. This was the pivot range right here for the month of April. Here's the pivot range for February. This is the one for January. This is December. One thing you'll notice about this one coming up in May, which is going to be between this line and this line, is that this pivot range is very narrow compared to normal, right? What is normal? Well, normal would be whatever it is for this market over the last, say, 6 to 10 months, right? What is normal? You know, right now this has been normal for a while because the volatility has been wider. So it always kind of depends. But if this is significantly compressed, you can use the eyeball indicator, right? Our eyes can clearly say this is compressed compared to over here. The implication of that is increased volatility for the month. Not only that, it could be significant volatility where it could be directional, or it can be, you know, in both directions, which means it would be volatility where, say, if we broke down first, it'd be an aggressive sell-off followed by perhaps an aggressive rally, right? That'd be a release of energy, but it'd be in both directions. If it were, say, in one direction, perhaps it'd be a major breakout and continuation, right? So there's many ways they could release that energy, but right now it's very clear if you just draw the lines on the chart like this. This recent high, this recent high, this recent high, today's high, this recent low, there, everything is compressing to a point where we're running out of space facilitate trade. And when you can't facilitate trade, you have to then see expansion from that range at some point. And the range is already set. Here's the range. If you go back to the beginning of February, our thoughts on this move was that this major sell-off right here was designed to set the boundaries for the trading range for the upcoming 6, maybe even 8 months or more of trading. And here we are 4 months in, and we've basically stayed within that range. This is maintained, you know, its range, its structure. It continues to hold. And again, you know, we can continue to see that. This range could continue to trade like this for the next 4 or 6 months, where we're seeing price basically come to the edge, maybe come back, maybe come up to this edge, come back, and for the most part, it stays within the range. I have said that since the very beginning. We've continued to update that thought process as we go, and you can continue to see where we remain in that range. Now, here's the reason why I mentioned that. Because, again, just basic market structure principles. We've trended up for so long. At some point, after a long road trip, you got to pull over and gas up the tank, right? You got to gas up the tank, maybe plug in if you got electric, but you got to refuel. And that's what this phase is. It's a refueling. It's required. You have to have this refueling in order to move to the next spot on the chart, regardless of direction. Obviously, this market has been very buoyant, very bullish. It's hard for me to imagine this thing just selling off. But at the same time, anything can happen at any moment. If there's a failure down through here, I could easily see a move perhaps back into 5,900 to 6K. You know, that could be done, and then we could bounce right back and still be generally in the range. So that's not to say we can't see a sell-off at some point. We could certainly see that. But overall, I believe we're building energy in here. I believe the predominant direction is up, which means the safest edge to do business is this counter trend edge right here. Every time we see a counter trend move, this is the area where bulls defend in the direction of the existing trend, because at some point the likelihood of breaking up is very high. So again, I would just continue to watch this edge here, and again, we could drop below that edge and trap and then go. But overall, the process behind a range like this is just to kind of, after it's so big, is just to compartmentalize. You know, this was such a wide move that sometimes you need to trade a little here, then a little bit there, a little bit there. You need to trade a little bit all the way around. You can't just do that because it's too wide. And that's what we're doing right now. So again, I think we're coiling up for a big move. I still believe if this were to break down, especially if we got into 6150, 6150 could be a significant buying opportunity. I mentioned it last time here. I mentioned it last time here, and it happened here. So I mean, that's just going to continue to be the case. Anytime you're in a strong trend and you have LVN support, that will always be the predominant idea. So right now, still building out, and we'll continue to watch to see how this one progresses. But again, it's coiling up to an apex, and once you coil up, it's got to start seeing some movement. Now, there is a phase where it could perhaps break down and break back up and kind of just stay within the range, because for the most part, we're neutral. But again, it's hard to do business in here. Day trading has been much, much better than it has been in years. But again, for swing, it's been very difficult because we haven't had the edges to really play. Yeah, there you go, Tom. That's a good question here. Tom's asking a question. Can you comment on the probability differences between trading the middle 50% of the range versus the full edge-to-edge range? Yes, and you know, again, I always like to do a visualization. So if you go and you bring out this as the range, ideally a balanced range, right? A D-shaped profile would look something like this, and that's kind of what it looks like. And then you would take kind of this little inner portion right here, and that's where the most of the trading is on either side of the 50%. That's your inner 68%, right? And basically it's one standard deviation on either side of the mean. And so that is your value area, that's where most of the action is, but the best prices are at the edges. So out here and here, this has higher odds to return back up. This is in the bottom, say the bottom, 4.5% or something like that. 4.5% of prices are down here or up here, whereas 68% of the prices are in here. So you're trading at the best edges. So the odds of seeing the move back to value when you engage here are better, and the size of the move is better. But when you're trading, when price is mostly hanging around here, there's nowhere to go really until you get to an edge, and it could continue to chop up, down, and before it gets to that edge. That's why I usually don't trade around the center as often, and I try to be very disciplined about waiting for this. And again, it can be frustrating in here, especially if you've been waiting for an edge, because there's only been one time that we had this edge, and it was right after everything fell apart, when everything was kind of getting hit. You saw volatility funds exploding, or imploding rather, short volatility funds. I mean, you saw all kinds of things happening here, but that was the one edge, and it led up. And then right here was the one time where we got outside and dropped right back down. Other than that, there haven't been many plays. And so again, I think this is coiling up to reach one of these edges pretty soon. Great question. ES over here, the ES looks very similar. Today's action was quite bullish. By the end of the day, it took a while to find its legs though. It kept trending lower till it finally turned around. Again, this one, if you connect these highs here, you connect these lows, you got a very tightly compressed action here. You're still between this 25% and this 25% right there, which is on either side of the 0% line here. That's the midpoint between these two extremes. That's a neutral build-out phase. That is a significant fueling phase where you could see big-time expansion, big-time movement when the time comes. For now, it's hard to really anticipate which way we're going to go. Obviously, an upside bias on the long-term chart is likely, but we could still endure another drop. I mean, as a matter of fact, we're probably due if we can't get above 27.31 soon. One thing that's going to be of note tomorrow is the FOMC statement, and the Fed interest rate decision is released. That's going to be at 1 o'clock p.m. tomorrow, Central Time, 2 o'clock p.m. Eastern. And basically that right there is very important. It's the 1 o'clock open price. So what is the open price at 1 o'clock p.m. Central for the various futures markets? And that will then become your FOMC statement level, the FOMC key level, for that date, tomorrow being the 2nd, so May 2nd. And you can see they become very important historical reference points and key pivots. And they can work just like any other pivot for the most part. Uptrending in this environment, and then this one in January sold off, never came back to test it. This one in March sold off, never came back to test it. So the environment has clearly changed, and it would not surprise me in the least to see another lower high here lead to another round of weakness. Now, if that scenario were to play out again, I still believe that bulls would come in and to defend wherever that point of rejection might come into play for a return back up. So I don't think it would be a meltdown that just takes off and we're dropping for the next 6 months. And so that's the idea right there behind this one. We're coiling up. It's very difficult to do business in here when you're compressed like this. You got to let it move. But here's one thing, and I will bring this to your attention in silver. When you get into this type of compression, you tend to see your move, boom, like this. And then whenever you see your rejection, you tend to come right back to the point where you were compressing the entire time, and usually you keep on chopping. Same thing if it was to come up here, you see a rejection, you come back, you keep on chopping. So there's going to be one major move followed by a reactionary move back to value. That's the high odds trade right now with regards to the broader market, including the ES, the NQ, YM, RTY, EMD, some of those types of charts. And so again, I'm going to be patient with this one. You're continuing to see signs that this thing is compressing, but overall, by the time this entire thing is said and done, I mean, we can back this thing up a little bit right there. You know, we could easily be something like this, right? Reaching for 30.53 down the road. But is it after something like this, or how does it go? How much more of this behavior do we go? Because if we go sideways another 3 or 4 months as expected, then we're really going to see a big move, and now we're shooting for up here. Yes, there is sound. Let's see here. There you go. Let's see if they get up and running with sound here. Hopefully so. So nice compression here in the ES. Again, if you look at something like the YM is also compressing. It doesn't look very pretty the way it's kind of building out right now, but again, this was such a strong move, and it all kind of started election day right there. Election day, big huge day. Since that day, look at how far we went, topping out the last week of January. Big impulse sell-off, a move right back to the mid, and now we got ourselves a key range. And from that point in time, we've been focused on, hey, you know what, this thing is likely building energy. Let's look to fade edges. There haven't been many edge plays, but at the same time, there's a shot to really get going once this thing starts to shake out a little bit. And because of the overall direction of the trend of this market since what, 2009 low, I mean, it's hard to beat this market. It's been going straight up 10 years. So I still believe if we drop down, this is going to be the best opportunity to buy on the board. You know, I don't know if it's going to be here or here or here, but it's anywhere below that pivot low, which is 23K basically, below that pivot. If we get below it and we cannot go any lower, it's going to be a quick fade back to 25, followed by the potential to see a move up to the top. And at some point down the road, we might even start to run down that 100% expansion target, which is the 30,000 level. So I mean, Dow 30,000 is around the corner once we start breaking this range to the upside. And again, I don't think we're done building it out. We might have another 4 months, 3 or 4 months of building this thing out before we start to run. But Dow 30K might be around the corner. So again, if price were to drop down in here, right, we drop down below this level, like I said, 23, then all of a sudden 22 might be a buy for 30 if you have a long-term horizon. So that's something to keep in mind. Again, that could be where you build a core position on a longer-term basis. Shorter term, again, nice rejection tail today. We've got more earnings coming out here pretty soon, and across the market. Apple came out pretty strong today. That could lead. At the very least, we have the potential to get up toward the middle portion of this range, 24.880. That could be a nice pop, but it's been back and forth. Again, we're compressing. Let's talk about something different here, like crude oil now. Crude oil over here has been a really good one overall. Very bullish market. If you go back to the tape a long time ago here, it seems like a long while back, last summer, this was our preferred area to watch for a trap, and then this was the preferred area for a buy, and that buy we talked about could get us as high as 63.75. And this is the type of opportunity we're talking about in the Dow right now, right? Where here's that low, and if we get below and trap, we could see the long-term benefit of that and see how it happened. You know, normally you don't have that setup. It's a setup that happens few and far between, but when it does, that's a core setup that it can get you core long in that commodity or that underlying. For me, for the most part, this opportunity is a quick move, usually a 2-week move to this middle point with the potential to bring it across the range. That's usually my, this is the bread and butter move. This is the, the move where you leave it on for longer if you really have conviction. And sometimes, yes, you get the continuation and breakout. It depends on the time frame, but that is exactly what we're looking for right there in the YM, something similar to that. So it played out really nicely. That's been the low too. 42s have been the low, and now we're trading up here near 69s. Here's something I mentioned pre-market, which is going to be a major level to watch moving forward. Okay, so this is the 67 level right there. And this is a nice little box that we've built out over the last 10 days or so. Let me update this indicator here. We'll go to a 10 period. We were looking at this in the trading room today. But here it is right here. For the most part, this range is very, very narrow over the last 10 sessions. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. If you take the highest high and the lowest low of that range, what is the range? That range then becomes that level right there, which is 3.01. 3.01 is 58% of its average 10-day range, which is 5.21. So anytime you're below 65% of average range or average anything, it's compression. In this case, it's a clearly evident that compression has entered this market, and now that will likely release energy very soon. So we're very close to seeing some kind of movement out of this range. Now again, given the uptrending behavior of this market, I'm more inclined to think that a breakdown could be a failed move with the potential to see a major trap and reversal to new highs. But I will say that 67 is going to be the key here. It's also the top of this key range right here. So if there's a failure to hold 67, say we break through it, the retest will be very important. Bears need to keep that area offered, and it could open up a move as low as 62 to 62.18. So that's the bear case here for crude. One thing we looked at in our trading room today was this right here. Say we're at 3, right? 3.01, that's the 5-day range right now. Let's bring it to the left here. You can see that over here we were that narrow before. We shot up on that move. Over here we were kind of that narrow, we shot up on this move. Over here we were kind of that narrow, we shot up at that move. And then over here we were already up there, never kind of compressed. So really, you can see that from here, here, we usually go about 6 to 8 points once we see the next wave of expansion. So what we talked about in the trading room is if we go 6 points or 8 points, just call it 7 points. Here's 67s. You break down 7 points, that takes you to 60. So 6 to 8 points would be somewhere about here, 59 to 61 if we were to break down. Now if we were to go up again, it could come down and go. So say 65 plus say 7, that would be about a 72 target. So again, you have some volatility that will come out of this range. This is the way that you would quantify that volatility. And when you quantify it, then you can start putting a plan together about how price might get there, and then you can do an options trade or trade the contract, whatever you do. In this case, I think we have a very good case here for 72s. With the current low of the month, it would put us into that zone, but if we were to drop with a failed new low and then pop say 65s, That would drop it down a little bit, but it would be about the same. So again, it's starting to push us in that area. So again, this is a very important little box we're forming. 67 is the key. If we break below it and break back above it and hold it, I think we got a good shot to squeeze. If we break below it and can't get back above it, then we're dropping back to 62 and as low as 60 in this one. So this is going to be one to watch. It's hard to bet against crude going up, though, especially with geopolitical events, which have kind of calmed down and softened a bit. But at the same time, escalation is always a tweet around the corner. Let's take a look here at the EMD. EMD compressing as well. This is the E-mini S&P 400, so the MidCap 400 futures contract. It trades kind of like the Russell 2000, but look at how clean the edges are in this one. Just beautiful symmetrical triangle. It's built up incredible energy here. From this back end down to that low, that's basically 1760 to 2K. So you're talking about 240 points of potential expansion once this thing goes. So once it breaks above 2K here, you have about 2240 on where this thing can go to the upside, which would be huge. Again, we're compressing to a point here where we might bounce a little bit. At some point, maybe we break down. That could be a huge buying opportunity. So all of these are looking very, very similar here with regards to the broader markets, the equities. Here's one that I really wanted to bring up. We talked about this one last month. This is the dollar index, DXY. So if you go back over here, that's April 2nd right there. We were compressing like this, and I mentioned that things are compressing. Look at the narrow pivot range. That could lead to a nice breakout or an increase of volatility. I said if it breaks down, look for a trap to bring it back up. If it breaks up and goes above 91s, we might start making our way back to 94s now over the next couple of months. And so this one did indeed break to the upside, and it's had an incredible rally here since it got above 90, now trading 92.40s, got into 92.50, so it's a very, very nice move. We're already halfway from 91 to 94, so any pullback could be a great continuation across the range. But anytime you go sideways, you know, for 3 months, you don't release energy just for a week or two. You know, you release energy for 2 to 3 months. You know, it's basically the energy being built up. This is the cause, this is the effect. It's equal. They're usually about equal. So again, this is one that has gotten a very nice breakout and could see a continuation toward 94 as long as we continue to see price maintain acceptance above 91. Here's silver. So remember silver? I was just talking about that a moment ago with regards to some of these markets here like the ES. Here's where price gets really tightly coiled. Value is basically right there. And then here's your major sell-off. And then you get rejection down here, and then you come right back to where price liked to trade, and then you chop some more. That's the trade that I'm talking about, where you can get a major directional move one way, and then once the rejection occurs, you come right back to the point of origin, and then you continue to trade sideways, facilitate trade around value, or at least previous value. So that's something where you can template the upcoming move off of in the ES or the NQ or the YM, EMD, any of those. Let's take a look at gold. Gold has been just a great range-bound candidate here. A lot of back and forth action throughout the first 4 months of the year. Great edges here to here. I mentioned before, right on this day, that we were rounding off. If it could get above here, we might have a chance to squeeze. But as we've talked about before, 1370 to 1375 is like 4 or 5 year resistance. I mean, it's going to take some major juice to get through that zone. And so when we started to break here and run stops below 1340s, that was an indication that we're likely headed back to 1300 to 1306.60. So that was the target, which we put out about 9 or 10 days ago. And we reached it today. And so in our trading room today, what I mentioned was that this is probably not the rejection day. We talked about what would cause it to become a rejection day, what would be the requirements for that to happen, but that tomorrow may be a rejection. And if a rejection does not occur, then we could be looking at a transition day where we're going to start to transition from this trading range into perhaps the lower range down below. So here's the deal with gold. We have a great trading range that has been intact for 4 months now. We're at the lower edge of the range. We're in a significant LVN in the composite profile. We need to see rejection. We need to see some sort of day like this, or we need to see some sort of stop run like that. We need to see price probe and close back above 1310 basically. If it can start to get back above 1310, this thing could be headed back to 1338 very quickly. I'd say 3 to 5 days later, maybe as many as 5 to 7. And then if you look down the road about 3 weeks, we're probably back toward 1360 to 1365. So basically that has been our trade idea for several rotations now. And it has played out basically every single time. Up here we got a little squirrely, so I backed off. This is the first time we were aggressive with directional conviction toward a target, and now we're back at this zone for a shot to bounce back up. Again, here's the failure portion. If price were to break down tomorrow and say it closes around 1290, that would be huge, because then a pullback could be sold for a move across the way into 1240 and 1280. And that could be the easy move, because there could be 1200 down below as well. Remember, we went sideways for 4 months here. If we start to break down, I could see us dropping as low as 1200. So again, that 1300 level is going to be very, very important. As I usually say, I tend to fade the edges until proven otherwise. But once a range gets really long in the tooth, you know expansion is due right around the corner. So that's when you start to be a little wary of the edges. So I have to really see some kind of conviction on this edge for me to buy it here, but otherwise we might see this thing melt down to the next major support levels, and that would be quite a move for gold. So let's talk about really quickly the long-term view of gold. I know it's harder to see here. Let's see, what if I'm going to go to a clean style here, and then I'm going to go over here to a weekly. Alright, here is the longer term view of gold. That level right there is 1375. Okay, this is 2018. This is 17, 16, 15, 14, 13. The last time we were above that level was right here at the beginning of 2014. 2013 was the last time we were really above the level. That's a long time ago in market years. And then look at this beautiful rounded behavior. I mean, that is gorgeous. This appears like it is ready to explode to the upside sooner than later. Remember, we are now toward the latter stages of this pattern's development. And so when I say we could be soon breaking out of this pattern, it's by the end of the year we're making a decision point, because there's not much room left to trade here before it either needs to come back down to the bottom edge of this range, which could easily happen. We talked about the euro recently and how that happened in the euro. It got all the way up to this point, couldn't get up here, so instead it dropped here, dropped below that pivot, and then made its way back up, and then eventually is now trading somewhere up here, right? So that was kind of like the euro's path. So I'm not saying it has to break out to the upside now. Again, the market can do any number of things, but the way it's coiled up, the way it has major resistance, this thing looks poised for significant movement. And again, if you can't get above 1375, that energy may get released to the downside, and we could be headed for 1050. And again, that would be perhaps a great buy back toward value. So that's kind of like the longer term view. Remember, if we did break to the upside, it's been 5 years in the making. So we could easily get back up toward 1800 and perhaps even run through that into 2K over the next 2, 3, 4 years, right? I mean, if this thing took 5 years, maybe 3 to 5 years out, we're at 2K. If we were to break to the upside and can get above 1375. Until that happens, then that's off the board. So I wanted to talk some longer term ideas there with gold, as you know, it continues to develop. I still think we have some more pullback, but that pullback could be bought for the next rise to the upside. So that's kind of a long-term view of gold. If anybody has any other futures you'd like me to check out, let me know and I'll get to them. There's a few stocks here we talked about last week that turned into amazing movers. One of the stocks here was one that I've had my eye on forever. That was VLO. What a moonshot this turned into. This one here had been coiling up. Here, let me bring up the actual. There it goes. So you can see right here, impulse sell-off creates our key range, and then it stays between that line and this line. That's the inner 50% of this range, and just trades in a very compressed manner. Last month, this was April 2nd. That's where we did our monthly outlook, and I mentioned that 90 was an opportunity to buy for a shot at 96, and then that could ultimately lead into an upside break that gets you into 108.48, and perhaps 2 months down the road as high as 117.01. Again, this target and this target is based off of this impulse move right here. That sell-off and the bounce back up gave us this range. This was the energy that built up to drive that move, and look at how far we've come. So a big time move toward those areas. Again, we were looking for targets into 108.48 and as high as 117 2 months out. This was 1 month later. So incredible movement out of VLO. At the time I talked about a straddle. 91.5 was the straddle that I put on there. The 91.5 straddle exploded. I mean, it was huge. You only needed to get above 97 and change, I think, for it to be 90. I forgot the actual breakout point now, but it was 97 something in order to start getting break even. I think down here it was like, I don't remember now, 88, something like that. But basically it went well past that. So it was a huge move. Again, a straddle would be when you would buy the 91.5 call, sell, or buy the 91.5 put. And so you do both. You buy both and see which way we go. You got to have enough volatility, enough movement. And so that type of play I really like if you have enough sideways compression and then you get some sort of event. This one obviously was coming into earnings, rallied into it, and it was just a great confluence of events. So that's a great one there to put on the fridge as a fridge trade, where you can always go back to it and look for opportunities like it. This was perhaps my favorite opportunity besides VLO, PBF was my favorite opportunity last time. It was the one we reviewed very last in the recording, so it was the last one we looked at. It was basically this candle right here. That was the buy. And you can see kind of the compression that happens here, the rounded behavior. Here's the breakout day, and then it pulled back to that point and gave us a rejection. So what I mentioned was any pullback into the zone could be a great buy for the upside targets that we marked out, and they were based off of, you know, these levels here. So if you look at that key level and we go back to here, the level we marked out was from that low. You can see it's saying, okay, if that's the low of the month, if we make belief that that's the low, because we don't know that that's going to be the low at the time, we're just we're calculating. We're thinking that might be the low, and if it is, this is your primary target zone between 36 and 37, as calculated by the average of the last 10 months. You don't have to worry about anything. You don't have to think about anything. You just say, hey, that looks about right. It's about average. You're not overshooting. You're not undershooting. You're getting a high probability move, and there it is. Now, this one did continue through it and turned into a great move, but there was a lot to like about this one. You can go back to the recording to see more about why I liked it. But number one, it was this compression with the major breakout, the pullback. You can see the PIMAs here. They came up to provide support after a pinch phase. The first major pullback can oftentimes be one of the most significant. That was an awesome one right there. So one to study as well. CLR was one that was very similar to PBF. You can see this was also one that I had as a long candidate last month on the 2nd of April. It was on that day there. You can see how it looks very similar to PBF. It had compressed right in here. Big breakout day there. Here's the pullback, and then bang, a straight continuation. Now, of course, this doesn't happen every single time, right? It just depends on every situation, and the situation was right in this case for some of those. You have earnings that's coming out here this week, and this one rallied right into it after a change of bias. So a really great continuation out of that one. APA was one we talked about as well. This one turned into a great move. We talked about ways to engage this one, including in the money calls and also selling a put credit spread. The 36-37 put credit spread was the one I talked about, selling the 37, getting the 36 for protection. What I like about that one is that, you know, by the time the options expired, which was about 2 weeks away, price had only really gone sideways at that time. But nonetheless, that put credit spread was max profit. You know, if you had bought an in the money 36 and you wait 2 weeks, I mean, time decay and everything just starts to eat away, and eventually that thing got going and hit the target. And so that's why you have to be very, you know, you have to just be mindful of which options you're executing and the types of move you can see. But this one was great because you had the failure below the 36.60 right here, compression below support, price could not go any lower, and instead popped back above support, made it a floor again, and then started to work its way up toward our 41 target, which was our first target, and then the 45 is still on the horizon as this thing continues to trend higher. So this was a great one here from last month as well. Again, you don't have to just buy the stock outright. There's many different ways to engage it to make money. The put credit spread on this one was a great approach. SBAC was another one that we had. This one took a little while to get going. I had been watching it this entire time in here for a shot at it coming back to 154s, and it took a little longer to go sideways, and then did the entire move basically in one day. Incredible. Now it's back at support and actually might start to make its way back toward 172 to 174 again. This has been a very reliable support level for quite a while. Back here in November, December, January, February, March. This was close in April, and now May. Basically every single one of those has led to a bounce of some degree. And again, you can already see some tail showing at the lower end of this range here. So that could be the early indication of a bounce. Not quite as qualified as some of the others with regards to the geometry of the candle, but it's at a great spot in the chart. All right, I wanted to start to flip through a few candidates. This is some live prospecting now, where we're going to try and look for something here that could lead to some great moves throughout the month. In the month of May, you have to be very careful. Again, there's the old adage, sell in May and go away. It's a very real thing. One of our members in the trading room today posted that from May 1st through October 31st, since 1950, if you put in 10,000 into the market, that 10 grand would be worth about $9,880, 98.82 or 98.84. If you put that 10 grand in from November 1st through April 30th, that same 10 grand was worth like 980,000, something like that. So I mean, there's a huge difference, and that seasonality is certainly real. But that's not to say that there aren't individual stocks that can't go up or individual underlines, but you do generally have to be more cautious. It's generally a time for me to just lower size during that time, those types of things. But there's always an opportunity to find some great candidates. This is one of them right now. Shopify, you got earnings here where it looks like they beat, and now you have a big tail. Let's see, they're already trading 127. Let's see, so it's 127.5 right now. This 123.50 level, which is basically the midpoint of today's range, it's also the bottom of the pivot range for the month. That would mean that it's last month's midpoint. So this level right there, that's a very important level. Watch 123.50. That could be a buy opportunity for a move back up. That could get you into about 140. So 123.50 to 140 could be a head for this one. What I like about this one is just overall it's been in an uptrending mode. It's had quite a pullback here, but at the same time has been rejected on every turn downward. It's had higher lows. Now it has a big rejection here. That could be the fuel here that leads to kind of a pop back up. So this is one to watch. Not my favorite by any means, but it's the first one that comes up on the scan here. We're going to be looking through several on the scan, so if I go through some very quickly, it's because they're probably not that good. CMI is one that I would consider as well. So CMI, so we have Shop, we have CMI as a couple here to watch. This CMI chart, what I like about this one is the major key level at 150. So that's a key level that we've marked. You can see here, here, there, and here, all with buys that led to varying degrees of strength. The first one here gapped up to about 163. This one moved up even higher, got as high as 170. This one here got as high as, say, 180. And now we're back at it again. You know, which one are we going to go to? I think easily, if we bounce from here, easily you can get back and fill the gap toward about 160. And then you have a shot to get up to about 170. I wouldn't really push it beyond 170 here because of market structure. But what we're seeing right here is a major rejection tail right there. You can see a little bit of a signal. What I'd be looking for is this midpoint, that's 152s. In the upcoming day, do we open above it? If we do we drop into it and see support? That could be the spot to buy it. If we close below this level at some point over the next day or two or three, this opportunity is done. So overall, we need to stay above 152s now for the most part. We could drop below it and then come back above it, but if we start closing, that's not good. So this is a very important level. It could be an ideal entry point that gets you a quick fill the gap. Again, 160. That would take you from key level to key level, 150 to 160. And again, there is the potential to see more of a push across the range, but I think this is the high probability move. If you measure from this low up, this would get you your high probability target zone. That's 161 to 165. So you can kind of see the ball game right here. This is one to keep an eye on again. Now when I mentioned like this is a nice rejection tail, you see everything here, I say, hey, it needs to stay above the midpoint. If not, the trade is off. Here is a case in point. This one is from last month. This was Humana. And Humana had a big gap up right here. And again, if you back this up to kind of the current day, it looked like this, where you have a kind of a rejection in these highs. There's your midpoint at 284, 283 and change. I mentioned, hey, this one could fill the gap. We need to be watching this level right here. that's the ideal entry. If we close above that level, the trade is done. Because if you close above the mid of a supposed rejection, 9 times out of 10 you come out and take out the high. It's just what happens, right? And so if you look at what happened here, day 1 was good. Day 1, price gets up here, boom, it closes lower, entry day. Day 2, price fails down here. It was a failed new low right there, failed new low, and then price drives through the midpoints and closes way up here. That right there changes the entire complexity of this trade. 9 times out of 10 you take out that high and then some. Again, this is why I stick to a disciplined approach. If I'm giving you an idea here and I say, this looks like a good buy because of this rejection, I could get in that trade and get out unscathed or break even, and then somebody else could get out with a big loss because of a minor detail like a closing below a midpoint, right? You got to know when to just let it go and jump on the next one. That midpoint is such an easy level to watch that can give you that sense of bias when the change of bias is occurring. So that's a case in point right there. That one was one I talked about last month, actually probably the first one I talked about, and then 2 days later it closed above that level and kept on going. And that tends to happen. It tends to happen. All right, let's see. Here's another one. This is VMC. It's quite a rejection down there. So if we look at VMC on a weekly chart here, it's had a nice uptrend. It's got a great range. And this is what we talked about before with the broader markets. If it's trending up like this and you got a range, this is the edge right here where you want to be a buyer, because at some point you might actually get a piece of the wave where you get the expansion, right? So this is a great edge right here. 110, 105, and we're at it right now. A nice LVN there. We've got quite a rejection tail for today. So if we bring it down to the daily chart, there's today's rejection at the previous month's low. So here is one that has an opportunity. Again, the entry is about right here between the midpoint and the previous low. Call it 109.90 to 110.10. That could be the entry that gets you right back to 118.31. That's value right now. And so that could be just a short-term move to that level. And again, there's many ways to play this. For example, you could buy the 110 call, and sell the 120 call, right? And that will give you a spread. That spread trade right there would do a great job, in case it takes its time, the time decay. At the same time, it also limits your risk, caps your upside as well. But that's what happens when you limit your downside risk. So that's an opportunity here that could be one that plays out very nicely here over the next several weeks. So we're going to keep an eye on this one. As a matter of fact, there are quite a bit of candidates that look similar to these. I'm just going to flip through a few of them here. This opportunity right here looks very similar to PBF from last month and CLR. This is Costco. And again, one of the things that was very similar about these two issues was this, right? This compression here followed by a major push higher, that expansion wave, the pullback into the trigger zone and go. And now we're seeing it again right now, which could lead to the breakout through this high, because here we've been building out a range for 5 months now. Here's December plus the first 4 months of the year. That could lead to a 4 to 5 month rally out of this thing. So right now this pullback is looking really good. I'd keep Costco also on the buy watch list. This is one where the entry point would be about 195. Here's 195 right there. Here's your 195.30. That's the midpoint. Anything below the 8 period into this area, that's a good spot. So pull back into 195s could be a buy for a shot at continuing higher. If we do push to the upside again, this low right here gives you an anchor point that you can then use to project your primary targets off of. That's your 100% target, 75%. That's your primary target zone. That's 204 quarter up to 207.83. That's quite a move. Again, you don't just have to buy the stock. You can buy an in the money call. This one might be expensive. You could buy out of the money call. You can, it just always depends on the odds of that particular opportunity. I think with this one, a spread makes a lot of sense. Again, maybe perhaps going slightly out of the money here, doing a spread where you're buying this one and then maybe selling that one type of thing. Maybe you can go slightly in the money if you wanted to. Maybe the 195 versus the 205, and create a spread that way. So several ideas there for this one. Good question by Dwayne here. Considering the seasonal tendency for May to October, will you consider short candidates? There are times where I do consider some. I haven't seen that tendency early in the summer in a long time. That tendency is usually sometime in the fall that may happen, like in October, that type of thing. I don't have really anything lined up for that. We have been using seasonality, as you may know, a lot more in the trading room with Visual Trader and also with Thinkorswim. And so I think the seasonality component is very important, but I haven't really seen any trades that are lining up for me to want to short that time frame. Instead, I'm still looking to buy most counter trend rotations for a while. Doesn't VT have a seasonality transform? That's a very good question. I don't have VT up right now. I closed it just before we jumped on, so I don't know offhand if they have a seasonality transform. That's a very good question, though. I wonder what that would entail. Perhaps just the color. The color would correspond maybe to the cylinder. Yeah, I don't know. We'll have to take a look. So yeah, this one right here looks pretty good to keep an eye on. This one reminds me of CLR and PBF from last month. Eastman Chemical here. This one is at the counter trend edge here, basically pulling back after the counter trend move. You got a nice support level with a nice rejection. This one's another one that could be bought. Again, when you're buying these, there's many ways that you can buy it. This is a $100 stock, so I understand that some folks can jump in 100 shares out of nowhere, or 200 or 500 or 1,000 shares, but some folks couldn't buy that, so they would have to resort to options, right? And that's a great way to trade something like this, and at least take a little piece of the action. And one way, again, I mean, look at this 100 right here. I mean, that's a clean level with a rejection. Here's the last time we were here. Here's the last time we were there. Here's the last time. So where is it that we could get to from this low? Again, we have a great high probability target between 106 and 108. That's about where we were these last couple of times. So again, we could easily see a bounce into that target. But at the same time, what if we go sideways for 2 weeks before we do it? In that case, a put credit spread makes a whole lot of sense here, because here's your 100. You could sell the 100 put, buy the 98 for protection. You're not going to make a whole lot, but you're bringing in, you're collecting some premium, collecting that income there, and it's a higher probability trade. Even if price goes sideways, even if it were to go against you somewhat, you can still make money. Whereas if you were shooting for something way out here and we don't get that move, you could still lose money. So you have to make sure you have the right strategy for the move to come. But this one is one of those that I think has a good shot to get to 106 to 108. And a put credit spread could be a great way to get in on that one. Here's AAOI. Now this is one we've had in our trading room for a while, since this day right here. That was like April 10th, April 12th. So that day right there was significant. We were below the 25.75. We have this very tightly coiled range here, and then a major break back above. And on that day, I mentioned that the first major pullback as deep as 25.75 would be a great buy for a push higher. And that ultimately, if that were to play out, we could be on a multi-month move back toward 50. So here's 50. Here's kind of like the 46 level. So that's almost a double. You know, if we got back to 25, which we didn't, a move to 50 doubles that. It got close. It got into, 26 and change. But that was a nice little move here. And it's given us another opportunity right now. Look at how this thing has been such a bearish issue here. You can see the moving averages have now started to change. You can see here lower value relationships, and now it's changed here and we're hitting it from above. So this is one that looks really, really good for the potential to see a rally toward the high probability target zone, which is going to be between 40.77 and 44.33. That's your high probability target zone. So you can see we pulled back right into this zone here. You can see the fast moving average coming up. All of this could lead to the next bounce toward 40. So again, AAOI, we've talked about this one already a couple of weeks ago, actually 3 weeks ago, and it's continued to push higher. Again, this was an opportunity to sell a credit spread. But when it's cheap like this, you got to make sure that the options are there. Sometimes it's not, and so you just have to play the trade, the actual underlying. But this looks really good for a bounce as well. Could be a great opportunity toward 40 over the course of the next month. Now again, this is all live prospecting right now. I didn't do any prospecting ahead of time. I mean, I glanced at a few charts, but I didn't really do any significant prospecting here. This is all live as we're doing it. And one thing I'm usually looking for, again, is mostly significant key levels. You can see I just marked this 62 level. Why did I mark it? I marked it because the 62 level shows a very clear division between bulls and bears, right? Like right here it's resistance, resistance, then it change of bias here, then it becomes support, 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 and support. So it's a very clear level between bulls and bears. You can see the LVN is right in here as well. So this is a really clean level. Oftentimes that's what I want to see. I also look for value in the charts. I look for where price is above value. I look for any significant key ranges that may have formed. So that gives me a kind of a blueprint of what to look for. So this is a rejection below the previous month's low. It's also into the 62 support level. It actually got to 61.98. It looks really good. And again, you can see a lot of these look very similar to each other. I still have to see price hold. Remember, we need to see it hold the midpoint. It could hold there for a day or two, sometimes 3. But by day 4, if it's not moving, it's probably going to fail, right? You usually want these opportunities to start moving by days 3, 4, or 5. Otherwise, that's where things start to break down. But this is the level to hold. I like the way that it's rejected these recent lows. I like that it bounced off of our key level. I haven't looked at this chart in a long time. So I've marked that, that level, that's the most important level, and it's evident right there. 62 was it. And it's the best line on the chart. So again, high odds move. If this was an impulse sell-off, at the very least we come back toward the midpoint of this chart. But again, it's very easy just to use the high probability target zone, and again, that's about the same area. So we could be looking at a bounce back up towards 69, 67, the lowest. Entry could be somewhere around 62.85 to 63. So again, this is one to watch. And what's the level where this idea would break down? It's right there. If tomorrow we open and we reject prices above this high and we close below this low, or sorry, below this mid, that idea is done. Nixing the idea and moving on to the next one. Right? No shedding any tears on that one. Just moving on to the next one until you find something that is working out, right? Here's HCA. This was a good mover for us over time. This has a pretty good rejection tail right here. I could easily see it go to 104. Not a whole lot to say on that one. I mean, that one's pretty clear cut right now. A ton of candidates coming out of this session right now. And again, it's all because we have a ton of rejections after this this rally we had today. We had the intraday rally, closed near highs or on highs, and that left behind some significant tails. When you couple that with previous month's lows or highs, you tend to get major rejections in the opposite way, or reactions in the opposite direction. So we could be looking at a move up toward 100 to 102 as a high probability target zone, and then as high as 104 as the opposite edge. So I like this one as well. That's HCA. So right now we got about 8 candidates and we've only looked at probably 10 charts. That's incredible how many there are right now. Let's see, I'll flip through some more here. This one had a major rounded top here. Tried to break down in another rejection of these lows. Rockwell Collins. Nice rejection tail here. Key range, or key level at 132. Went way below it into 130.63 and then closed back above it at 132.23. Again, I'm a big believer in market structure. It broke down below this market structure support, could not maintain acceptance below it, so it rejected and closed back above it, threw off a signal, and again, it could be an easy bounce back toward 136.5. We don't have to shoot for the entire range. It could easily get to the top of the range, but from rejection to value, to acceptance, that's what we're looking for. So this thing could get to high as 136.5. If you measure from the low, your high probability target zone is 135.53 to 137.16. So your entry point would be between 131.50 and 131.80. If price drops into that zone, that could be an opportunity to bring it into this zone here. Again, that type of move would occur, you know, over as high as 3 weeks, as much as 3 weeks, and as low as 5 to 7 days. It just depends on how crazy this one wants to get. So a great little opportunity here as well. That's COL. It's raining signals here. I mean, shoot, these are some fantastic signals in here. Terex Corp has a nice little range. VFC, pull back after a squeeze here. Again, if this is starting an uptrend, that's an ideal buy. TPX. If this is a change of bias happening right now with a rejection below 43s, this could be a major squeeze. I don't really know anything. Temper Sealy International. This must be the beds. Tempur-Pedic. Value on a higher time frame chart would be 58.47. Right now we're trading 44s. Here's 58 up there. So yeah, this one has a good shot to get a major squeeze if it can get above 47s here. That's TPX. Again, a put credit spread might be a way to go on that one, even if it doesn't go, because it's been mostly sideways. It's showing signs that it could go, but you really never know if it's going to go, right? Especially if it's kind of a cheaper one. So we'll keep an eye on that one after it's been beaten up. But there may be a change of bias coming for this one. One to keep an eye on. XLI showing some rejection. AEM was another one we've talked about before. This was a great squeeze coming back right now, showing rejection here at the previous month's low. That could be another buy opportunity back toward recent highs at some point. That one's been a good one. Got quite a bit of buy candidates to look at here. I don't even have any sells even that I've looked at. I'm just trying to flip through the last ones here and try to get to a sell side and see if we're missing anything here. This is one UDR that looks like it's compressed and ready for major expansion. BRO with an initial breakout and retest. Keep an eye on BRO. Brown and Brown. Bro looks ready to break out. Major uptrend, and recently here it has broken to the upside. So anytime you have it like this, where you have a nice clear range and then you break out and you come back like that, you know, there's the potential to see a big move. And if there's any failure to hold 27s overall, then you rotate all the way back down to the bottom. So right now bulls are trying to keep that edge bid, so that's one to keep an eye on for a short-term bounce. And that's pretty much it right now. Looking at some of these candidates, not seeing a whole lot on the sell side. We got plenty to look at on the buy side. I'm counting 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candidates. Starting with Shopify. We looked at CMI, VMC, Costco, EMN, AAOI, PCAR, HCA, COL, TPX, and BRO. So that's a pretty decent little list of stocks here to watch into the rest of the month. It's a lot more candidates than we kind of had coming out of the April session, but the April session actually turned into some fantastic movers, especially some of the ones that we looked at today. Going to be getting this recording up and posted here, so I'll let you know about that. Also, Swing Trade Pro 2.0. Very, very soon we'll be releasing some info and some news on that. So if you go to pivotboss.com, right here on just below the middle fold here, get the latest news. That'll put you on the mailing list, and then you'll be the first to know about Swing Trade Pro 2.0 coming out. It is going to be incredible. You're going to love it, and I'm super excited to get it out to you, putting the final touches on it, and you all are going to love it. So looking forward to getting that out to you. So if you want to be on the list here, jump on it right there. And again, I'll be posting that recording here pretty soon. Tomorrow is the FOMC statement and the federal interest rate decision, 1 o'clock p.m. Central Time. Again, the open price is going to be very, very important. Note that open price and market for your major futures contracts that you trade. You're likely going to see some great movement off that level, so keep an eye on it. All right, everyone, thanks so much for hanging out with me today. Enjoyed it, and we'll be back at it again soon. Take care, and I'll see you soon. Take care, folks.